everyone to the second Preservation Next California Academy session. We're really excited to have you all here. My name is Sarah Haas. I'm a Senior Director with Enterprise Community Partners, and I lead Preservation Next along with a great team of folks from California and other parts of the country. We're really excited here today to have some great guest speakers and to showcase the Preservation Toolkit as we talk about organizational sustainability and business planning in terms of small multifamily preservation.
Enter your meeting ID.
Just so folks know, as you come in, if you can make sure that you are muted. Everyone does have the ability to unmute, but just while folks are presenting, ask that you stay on mute. Just a couple other quick housekeeping items. We are recording today's session, and we'll share that recording and the PowerPoint decks out with folks after. Second, we are using the chat to track questions as we go throughout today's session. In addition, we will have a Q&A portion of today's call. And during that time, you're actually able to raise your hand and go off mute and actually ask questions verbally. We'd love to have some audience interaction and engagement as well. So just want to review the agenda with folks. I'll give a very brief overview of Preservation Next for those folks who didn't join us a couple weeks ago. We'll then jump right into our guest speakers with some great presentations from Karoleen Feng with the Mission Economic Development Agency, or META, Rebecca Foster with the San Francisco Housing Accelerator Fund, and also joining us for our Q&A discussion later, we'll have Johnny Oliver with the San Francisco Mayor's Office of Housing and Community Development. We will then have an audience Q&A portion moderated by Ruby Harris and Caroline McCormack with Enterprise and our Southern California and Northern California offices. And then I'll spend a bit of time just highlighting our Preservation Toolkit and some of the aligned resources you'll find that you can check out after today's call. And then give you a quick preview of our next session coming up on December 1st. So let's jump in. Want to first thank our funders, without whom we wouldn't be here today. So our work was seeded by Mackenzie Scott. A huge thank you for those funds which enabled us to build this program. We're very thankful for our funding from Kaiser Permanente, which is enabling us to bring not only this California Academy to you today, but also to bring the work to Colorado and the Southeast in 2023. And then lastly, thank you to CIT Bank for your support. Next slide. So I just want to give a quick overview of Preservation Next and what it is. And as we jump into that, well, I'll do that first, and then we're going to do a quick poll. So everybody get yourselves ready. So Preservation Next is a program Enterprise has developed to focus on the preservation of small to medium multifamily properties, while also protecting residents from displacement. And when we talk about small to medium multifamily, we're talking largely about properties under 50 units, though depending on the market, that could be a bit larger in certain places. We feel like this is really critical because we know these properties provide the majority of the affordable housing across the country and largely are not protected by any sort of subsidy or other regulation that protects that affordability. We know that they're at risk in terms of market risk, of course, but also these are largely older properties, which may have physical condition issues and other deferred maintenance challenges. Given that, we wanted to really dig in and invest to try to catalyze the preservation of this critical stock. We're doing that work through Preservation Next, and we're going to work to protect existing affordability where it exists, provide housing stability, and prevent displacement. We want to make sure we're investing in healthy, sustainable, and resilient homes and fostering responsible stewardship of mission-aligned owners. This work is happening through three pillars. First, Preservation Academy, which you guys are all joining today. Second, our Preservation Toolkit, which launched along with the Academy, and we'll take a look at it a little later. And then third, we're piloting a capital product in some of our markets so that we can also bring those capital solutions alongside increased capacity. Next slide. Just want to highlight our next sessions. So Jesse will pop the link so that you can register. We have registration links up through January 12th, with the remainder coming very shortly. You can go ahead and register for those sessions and get them on your calendar. We hope that you'll join us for our entire series, which really seeks to walk you through all the critical components of this work. And we will have both speakers local to California as well as national speakers joining us. Next. So I just want to introduce our guest speakers before we jump in. So we're really very thankful to be joined by some folks with amazing experience in small multifamily preservation from California. So first, we will hear from Karoleen Feng, who's the Director of Community Real Estate with the Mission Economic Development Agency, or META. At META, Karoleen established the Community Real Estate Program to reverse cultural displacement and gentrification in San Francisco's Mission District. She's been instrumental in jumpstarting META's partnership with the San Francisco Housing Authority, constructing 500 units of affordable housing and the preservation of dozens of small apartments. So we'll hear from Karoleen in just a moment about META's journey in small multifamily preservation. Next, we'll hear from Rebecca Foster, who's the Chief Executive Officer with the San Francisco Housing Accelerator Fund. Rebecca is the founding CEO of the San Francisco Housing Accelerator Fund. And since 2017, the fund's investments have supported over 1,500 permanently affordable homes for more than 2,600 residents. Previously, Rebecca served as Director of Social Impact Investment under the late Mayor of San Francisco, Ed Lee. And then we also will be joined during the Q&A portion of today's presentation by Johnny Oliver, who's the Director of Preservation, San Francisco's Mayor's Office of Housing and Community Development, where he oversees the city's acquisition rehab program. And prior to joining that team, he served as the Associate Director of META's Community Real Estate Program, where he led their housing preservation efforts and work in the Small Sites Program. So really excited to have all of you joining us and to share your experience with folks on the call. All right, next slide. I think with that, we're actually going to jump to Karoleen. All right, so there we go.
Good morning, everybody. So happy to see our friends, both from San Francisco as well as Southern and Northern California, many of you who I've known over the years. So happy to talk today about how we got from where we got to, and really kind of this experiment that started in San Francisco with a lot of community advocacy. Also happy to see community advocates saying that, hey, why don't we look at the private market and flip it on its head by actually buying buildings off the private market, starting from 2009 in advocacy to be able to start that legislation. So as I go through this, this is a standard slide deck, and just wanting to kind of do another introduction, talk about how we got here from a organizational standpoint, starting first with fundraising, because this would not have happened, frankly, if we as an organization didn't also bring our own dollars to this, how we thought about this from governance, and then finally strategic planning, and then leave you with a couple of materials and questions for you to think about as we continue the many sessions that Enterprise has planned. And so thank you, Enterprise, for putting together this series, because it will really scale and grow this this work, which is so vital to really what we're saying is the housing crisis. One of the key elements, as folks know about preservation, is that we're keeping families where they are today rather than production, which is just as important, but waits for at least 5 years before we can bring our families back. And then we have to, go through fair housing and lottery laws to be able to do that. So with that, I'm going to jump right in. We're going to talk about how META was able to leverage our services and collective impact for housing development, some ideas on seed funding for building your housing development, knowing that there are groups in this conversation who are in different places in your growth into doing preservation, as well as different other constituent players in this besides the organizations themselves. And then how you as an organization can either set up your own governance structures to shift to housing development and or support that shift as supporting organizations. And lastly, some clarity on what's required for various models of housing development and some next steps for capacity building. With that, can I have just folks in the chat? We don't have that much time today, but just folks in the chat to kind of just say one thing you hope to take away from today. So as I'm structuring the conversation and try to read the chat at the same time, we can also make sure that we are building in some of your desires and why did you decide to even come to the session to learn about organizational capacity building. So if you could just put that into the chat and pop that in the chat, I'd greatly appreciate it. So I'm going to start. Yes.
Sorry to interrupt you. Can you put your deck in slideshow mode?
Oh, I'm so sorry.
Oh, good.
Thank you. Thank you for reminding me, Caroline.
Yeah.
Totally appreciate that. With that, I am going to jump right in to kind of talk through what we created as a model for looking at what your organization might need to start off with as you build out your preservation team. Knowing that, again, different folks are in different places. Some folks already have robust housing development pipeline, and some folks are just starting out. So when we were considering this, and I'll talk a little bit more about Meta's larger trajectory in a bit, but when we were considering this, Meta was a services agency that was pivoting from being in services for 40 plus years into doing housing development. And so as a sort of baseline, we would ask folks to consider what would be needed as an infrastructure, and both in the real estate development side, so having a housing director at about 1 FTE to having your project manager that would then be the one who would lead through the preservation work, having asset management so that when you own the property, you actually have somebody to watch over the long-term financial health of the property. And if you have the capacity, also resident engagement. Preservation, unlike new construction, has its unique element of having residents already in place. And so it's very critical to have some staffing, if not partnered with other folks that can actually directly engage with the residents as soon as you're thinking about acquiring the building. And then accounting to make sure that you're really, once you start owning the building, you're on the clock for making sure that you're tracking both the profit and loss as well as the long-term liabilities on the debt for the property. And so having some level of accounting in place. We would typically assume, and this is, in today's inflationary market, it is probably much more than this, at least by 10%, but we would assume about 100 to 120 K per FTE on average, and then adding benefits to that. We would also suggest that you might want to consider contracting or outsourcing some portions of this as you're growing, depending on your own capacity. And then lastly, where we were able to do this was actually, we had internal capacity that we shifted. So a good example of this is Johnny Oliver, who's now at MoCD, started with us actually in our housing opportunities team doing housing counseling, and then grew into his work when he was at Meta. And so that's an example of how you could look at internal capacity in your own teams, not necessarily saying, hey, you had to go outside. And certainly we found that was also helpful for, like, you actually have a knowledge about what the organization is, and you also have a knowledge of what the work is without maybe necessarily that full knowledge, but at least that level of knowledge is something that takes sometimes years to build in addition to the actual technical skills themselves. So it's separate from the staffing. We'd also say that you should probably be thinking about how you're going to actually fund the acquisitions themselves. And so we typically would suggest that you look at what you need to put into escrow when you're first buying the building, so 3% deposit, having at least $10,000 to $20,000 for due diligence, and then working with the San Francisco Housing Accelerator Fund, and Rebecca will talk about that in a bit. We've been able to do loans that are basically above the value of the property and include the rehab, but at the same time, they require some level of equity. And so that's about 2% of what the total project costs are. And that would roughly come up to essentially $150,000 to $200,000 for the first two projects. And you can do that by including that in your sort of startup asks to your funders. And so that's what we would say if you're starting up, in addition to sort of projecting for your staffing costs, also being able to project for having some level of at-risk capital, essentially capital that you might lose, but hopefully won't, of about $150,000 for your first two projects. So moving on to then, how do you actually make all this happen, right? Because that's a lot of money that you might have to be thinking about in your first couple of years as you're growing this. So our journey started with us actually knowing why we were doing this. And if you can't make that case, it's very hard to just sort of jump into asking, especially for grant making, for grant funders to understand this. And so for us, we made the case that in the mission, we had the urgency of making this happen today, of buying buildings and not waiting until tomorrow. We're also very clear why Meta and why not any other organization. So this was really tied to our mission, vision, and other programmatic goals. We also took advantage of leveraging funding and looking at other ways of getting investments, including from local neighbors, and we'll talk a little bit more about that. And then ultimately, the proof is in the pudding. When you start buying your first projects and showing that you can do that, you can then fundraise for more money for future projects too. But it is always sort of that first round of capital that is always the hardest. And so being able to make that case is really important. For us, we made the case and we actually did studies. So rolling us back to 2015, and for those who are less familiar with Meta, so we are a 45-year-old services agency now. And when we first started in 2014, we were at a place where we were seeing our families leaving. We were only doing services that were financial empowerment for helping our families to figure out how to do better financial budgeting, how to access homes, how to build their businesses. At the same time, we were also launching what we call the Mission Promise Neighborhood Work, which is looking at how do we wrap around our families in their educational achievement. And we knew we could do all that, but we were still losing our families because they were getting pushed out of their buildings that they lived in. And so we commissioned a study. We worked in coalition and in alliance with a lot of our other community members who stormed City Hall to make it very clear that the stats were there. If you look at what was happening between the 2000 to 2010 census, we had lost 8,000 Latinos, and that was over 25% of the community. And if we projected forward from 2010 to 2020, sitting in 2014, we knew that anybody earning less than 75,000, once they were pushed out, would not be able to come back to the mission because of how much it costs for new rents in the mission, $3,000 for a 1-bedroom, $5,000 for a 2-bedroom, which are impossible prices for our families to be able to afford. So that was the case that we made over and over again, showed the stats and used that for our fundraising and our collective messaging to be able to make it clear why was preservation so important and why was it so important in the mission district. And that was what helped us to launch our fundraising. I feel like I'm going very fast, so I do want to pause and just check out some chat questions. And so just to kind of read while you guys are absorbing this and make sure that I'm answering questions too. Thank you. Okay, so to be able to then fundraise, we actually had to look at multiple different options. We had to look at what would fund us for our staffing, as well as what would fund us for what I was calling earlier that at-risk capital. And so there were 3 avenues of funds that we went after. For our staffing in particular, I'm going to start with the far right. We looked at grants and we were able to treat those as revenue and we didn't have to pay them back. And we just had to achieve certain outcomes. So those were very important because without those grants, we wouldn't have been able to have the seed capital for our staffing. And the way that preservation, like housing development, typically works is you get paid when you buy the building and or when you have completed construction on the building. So for the first few years, as you're launching this set of work, you actually may or may not have the money coming in. That payment is in the form of developer fee, as some and most of you are familiar with. And so without the grants, we would not have been able to launch the work that we were trying to do, because we would have had to pay for what I was saying earlier, that $100,000 to $120,000 on average plus benefits cost for the staffing. And so the grants were what paid for that. And those grants for us started first with our Mission Promise neighborhood work. For other folks, I think having the ability to access multi-year, having the ability to look at, there's many more capacity building grants out there right now, especially for BIPOC organizations, than there have ever been before. So I think trying to figure out how to really convert those grants into specifically affording your early years of housing development is really critical. And then separately, we were able to reach out to foundations specifically for us, San Francisco Foundation, where they gave us initially an $800,000 seed grant to, seed investment of what we call program related investment. It's essentially like a line of credit. So for 7 years, we're able to pay interest only on a quarterly basis. So then we can take that money and use it as essentially revolving monies that we can use to buy properties, put down the down payment, and then and then when we have the full financing for the property, then repay that amount so that we can then use it for the next property. So it does have to be tied to a specific purpose, and in our case, we were very clear it was tied to the preservation of small sites in San Francisco. And then the last is capital, and this capital is the capital that is the monies that's actually the loans on the property. So to buy the property, to actually have those loans, we in San Francisco have two main sources of those. The first mortgage, which now San Francisco has made into their own first mortgage with a bond, and that is what we call true hard debt. So that's money that actually is paid to the lender on income of the property every single month. And then separately, the soft loan, which in San Francisco is a residual receipts loan. And I know with the foreclosure intervention program may be considered a grant, but regardless, it's a loan that's on your asset and means that you would be required to pay it back at some point in time. And so that is typically based on the asset, whereas the first two are in some ways based on your organization's own ability to pay it back or your organization's ability to fundraise. So being able to access all of these different sources of funds were what allowed us to launch in the first 5 years of our work. So then converting that into exactly what I was saying earlier, for Meta, what that looked like is in the first 3 years, we were able to go after, and this actually was in the last 8 years. These were the various grants that we were able to receive to support us. LISC and Enterprise both have capacity building grants through the HUD Section 4 monies. And so being able to access those, as well as some longer term multi-year grants that we were able to receive from various banks. And then some smaller bank grants too. We were also able to get, as I was saying earlier, from San Francisco Foundation, a 7-year program-related investment that was $800,000, and that allowed us to essentially use that as revolving capital. And then lastly, as I was saying just now, the capital that is actually for buying the building and the construction loan plus the perm loan came from San Francisco's Mayor's Office of Housing Development, San Francisco Housing Accelerator Fund, and initially various banks who were interested in doing the first mortgage. So I think just really thinking about in trying to get to how would we do this is thinking about who cares about the issue, who in your neighborhood and or community is doing this work, making the case for what they may be seeing as earned income, providing some value to creating direct services or housing stability, and then expanding existing funding. We were also fortunate that coming as a services agency, we had already had some of those relationships, but really those relationships might have been on one side of the bank. And so we were able to then convert those into larger relationships on the other side of the bank to be able to ask them for more funds. And then local individual philanthropists. One of the things that launched some of our early buildings was having neighbors who were interested in lending money, and they were actually using their own line of credit on their own homes that they owned to be able to lend. And then some of them were saying, you know, I put money in a certificate of deposit and that's not really working locally to help support what I know is happening in my neighborhood. I'd rather put $10,000 towards supporting you all. How can I do that? And so we did, for a couple of buildings, launch a local investment fund that we piloted for a minute. And so that's another method of trying to get that early seed capital to be able to bring that together. I know, for instance, down in Southern California, Little Tokyo Service Center is doing that with seed capital for buying commercial buildings too, along with ELAC, I believe. And so I'm going to shift over then to, besides the money side, what do you need to do to also show funders that you actually can do this? And what they're always looking for, as folks who are familiar, is where are you in your governance? How do we know if we put this money in that you are going to be a stable organization, and also an organization that, as you're looking at the risks of buying real estate, you actually can make those prudent decisions? And so we had to first convince our own board that this was the right pivot. And so we had to explain why, again, internally, why do we want to do preservation work? Is this really within our mission? And then look at the composition of our board and making sure that as we grew, we actually added board members who were with some level of real estate expertise. Ultimately, as we were adding them, we created a community real estate committee that allowed us to actually move decisions through faster. As a services agency with 5 separate programs, in the early years from 2016 through 2018, our board started getting more and more frustrated with the fact that despite the fact that we have 5 very robust programs, half of the board meeting, which was a 2-hour board meeting, was spent on real estate decisions. And so we really quickly shifted into how do we use our committee more effectively so that the board trusts that there are a group of professionals who are part of the board and also maybe outside of the board, but who can help make sure that they're vetting those decisions before it goes to the full board, so that the board can actually continue to make those decisions effectively, and know that, you know, there was a higher level of vetting instead of just staff saying, hey, just we're going to buy a multi-million-dollar property, yes or no, Meta. And instead it was like, we're buying a multi-million-dollar property. Community Real Estate Committee has actually viewed this and asked the hard questions of staff to make sure that we're actually thinking about what are the short-term risks of buying the building, what are the long-term risks, and then ultimately making that recommendation to either make a couple more changes before it goes to the board, and or support the board in making that final decision to purchase that property. So having that governance structure is very important. And then continuing to do risk assessments for the organization, and helping the organization as a whole understand what is the financial impact as you're buying more buildings, and how do we manage for that risk. For us, we actually created a risk matrix, and let's see if it works. It did work. So for us, we actually created a risk matrix that allowed us to, and actually I should totally credit, this came from our larger affordable housing community within San Francisco. So I cannot even begin to credit how many various organizations actually participated in various versions of this, and then handed it off to another organization. Our last version came from Chinatown CDC, but I know that this also went through like HomeRise, it went through TNDC. Other folks have used some similar matrix, but essentially it's looking at, as you're looking at buying the building, how does the board in a more quick manner know whether or not we're covering all the risks? And so we as Meta look at the biggest risk is does this even meet our organization vision mission? Can we secure the financing? Can the project generate the developer fees, which then translates into the funding for the staffing as well as to carry the project? And then can it support itself long term? So we look at financing, physical, the community impact, and other ownership considerations. So going through this risk matrix with our board really helped our board to feel more comfortable with why were we buying each building as we went through it. Obviously, as I'm describing this is a long-term process. We went from 2014 through 2018 building this capacity and starting to establish these risk management systems. And so knowing that we have to do that took us many years of honing that, including finding the right board members, making sure that we were shifting their capacity too, from going from not having any involvement in affordable housing to having more. I know we have some SFHDC folks on the call. And so we were then able to, work with some other organizations, including SFHDC, to do similar work where, although SFHDC had been engaged in housing development, the sort of rapid turnaround of preservation, where you're actually going from looking at a property for about a month to 2 months to making an offer and buying a property within 4 months, is something that is a monumental decision if you're thinking about investing or borrowing millions of dollars, and how do you have the right board structure for that? And so we shared how to do this with SFHDC and help them to set up their committee structure that actually is similar in this way of like making sure that there's additional folks to be able to make this happen. So with that, I'm going to pause and say that those were the key elements of what it takes. I'm actually going to share then how, if you're looking into this, these are clicks. If you're looking into this, how you would do this. And so we converted this into, as we were looking at our own trajectory, into an organizational assessment. So we're going to leave this behind with the enterprise folks, but essentially, let me see if I can do full screen. So simple yes, no questions, and they go through governance and financing for you to assess as an organization, where are you in being able to both have the board structure, have the finance structure, have the legal structure, and have done that, making the case, the strategic and business planning, as well as lastly, financial readiness, having the actual money on hand to launch into preservation, so that you can be ready to actually start doing or continue doing this work, but maybe scaling it even more. And sorry. I'm trying to go back one screen, and I apologize, folks, that it's not working. Hold on, let me stop sharing. Maybe that'll help. Here we go. Okay. What are you guys seeing again? You're seeing yourselves?
Yes.
Okay, here we go. Okay, thank you.
Perfect.
Hold on. Okay. Oops, I jumped a few slides. So once you've taken that organizational assessment, and this is a self-assessment, if you will, then hold on, get this bigger. Are you seeing a big screen? Or are you seeing my desktop?
Desktop, I think.
No,
You're seeing my whole desktop. Okay. Once you've taken the assessment, then it's a self-assessment to then understand where are you in terms of your own stage, and then what would you want to do to grow to that next stage to be ready, so that stage one is essentially you're still, early in your actually we had stage 0, which is you don't even have an organization, which we actually have talked to folks who are not even there in terms of an organization. They may be just various nonprofits that have fiscal sponsorship, to you're in early organizational development, to you're in stage 2, where you actually have been an organization for a while, but your real estate program has either been in hibernation and or has already been launched, but not fully, to then stage 3, where you now can actually start buying buildings and have even done some level of buying some buildings. To by stage 4, you've got a pipeline. You're moving on preservation, and you have enough that can support your staffing costs as well as your ongoing infrastructure costs to actually make this a viable program. And then of course stage 5 is like you're really there. So these are the different stages that we then, as you were answering that assessment, which again we'll share after this, you can then sort of see, okay, well, I'm over here, so that means that really, let's say I'm going to just start first with somebody who might be in stage 1. They have 501c3 status, but they don't have a board that is fully, folks who have nonprofit real estate development experience, and or they don't have somebody who has legal counsel, so they know, hey, the next stage is for you to then start thinking about this if you want to get into being able to start having a real estate program that's live, and or what do you need to think about if you're trying to grow into having a regular pipeline. So I'll leave this and then go back to the slide deck to then to then share at Meta, The other piece of our organizational development is how we then continue to hold ourselves collectively accountable. So we use results-based accountability so that we look at all of our results. So again, as an organization, Meta is a services agency at heart, which means that we have, in addition to our housing development, which we launched in 2014, with the results of families staying in affordable and quality housing, we have 5 other results, and being able to look towards those results are how we then know whether or not we're making a difference. So we use results as a way of tracking our strategic plan. Everybody does it differently, and just this is how Meta does it, so that we can show to our funders, but also show to ourselves, are we really making a difference? So the results, all 6 of those results are here. We use our theory of change to be able to get to how does that then work to actually the mission and the vision we have for Meta, which is generations of Latino families being able to call San Francisco home, or they can choose where to call home, rather than being told, hey, you have to move out of here because you can't call it home anymore. So to date, that was a trajectory that also embedded Meta's history. We went from 0 buildings in 2014 to 1,400, which when we were tracking in 2014, we said we needed to have 2,500 homes for families to either come back to or be able to stay in, to be able to effectively turn the curve for displacement. And so we're on our way. We were hoping to achieve that by 2020. We knew that that was a very ambitious goal, to say within 5 years that we would be able to have 2,500 homes, but we're on our way at 1,400 in 2022. And the green represents the buildings that we've bought. As you can see with our small sites preservation, well, maybe you can't read the numbers, but the smallest that we've bought is 3 units, and the largest that we've bought so far is 26 units. What works in the mission, and I know that this is not necessarily the case for all folks, is we're in this 2-mile radius footprint, more like 1.5 mile radius footprint, which has really supported our property management, and they've been able to do this. At the same time, we're growing into other neighborhoods by supporting the capacity of other groups to be able to be in other neighborhoods as they grow their capacity too. So again, this is the same stats, and just repeating it. And so I'm going to leave you with a couple of questions. I went through that very quickly, but for you to think about, as you even think about what model of affordable housing preservation would you want, again, either for your own organization or as a jurisdiction that is trying to support this. There are multiple models out there. There could be a lead agency that leads the work. And which lead agency would that be? How would they have an advisory board? What would be an effective decision-making structure? What kind of staffing would be needed? I shared the model that we use for Meta. Or if you were actually building the capacity of an existing organization, that is closest to Meta, right? And so having the startup funding to support that organization, what would be the biggest risk to the organization? How would it be managed? How would you make sure that you have buy-in from both your governance, meaning your board, as well as your executive leadership, and even community? Because if community doesn't support you, then you're still constantly fighting an uphill battle. What other resources can be leveraged, and what additional infrastructure would be needed? Or forming a brand new organization. I know some folks are thinking about that too. Who would lead on forming the new organization? That is the sort of longest hill or longest path, but I think it's certainly possible given, depending again, different organizational strengths. Who would lead it? How would you establish that new board? And what would be built into this structure to retain community accountability and connection? And then where would the financing and seed funding be sought? And then what type of staffing and infrastructure would be needed? So I'm going to leave you with one final thing, which is actually the segue into Rebecca. We would not have done this as Meta, as despite what we showed in terms of the number of units, if we didn't have all the parts of the ecosystem making this work. And I would be remiss if I didn't, and I apologize for not adding this, if we didn't also add that we did this both with our mission advocacy community, as well as the Council on Community Housing Organizations, CHOO, in pushing for the legislation and also the funding for the capacity building. So in San Francisco to date, I think, and Rebecca will show the numbers, but from a small program that San Francisco launched in 2009 as a legislation that then went in 2012 in including some inclusionary housing funds, to then ultimately becoming a pilot program in 2014 with $3 million. That would not have happened without these separate players. And so I'm sharing that in 2013, we launched with a small sites program with the Mayor's Office of Housing and Community Development. We were one of the first. We were not the only ones. There were other players in this, but we were one of the first to make this happen. And then with that, we bought buildings with that, and we were then able to get more funding for small sites to the tune of around $24 million per year over 2014 to 2017 with so from that $3 million pilot, once we showed we were able to buy our first buildings, we were then able to increase willingness to buy to buy more buildings to the tune of 24 million with a housing bond that passed in 2015. And then the San Francisco Housing Accelerator Fund was launched in 2017 to help us to acquire even faster. And Rebecca will talk a little bit more about that. At the same time, we were also able to secure this program-related investment from San Francisco Foundation to also expand from, we were buying in 2016, we bought our first 2 buildings. And then by 2017, with Johnny coming on board, we were able to buy, I believe 11, if I'm right, Johnny, in that first year when you came on board, if not by 2018. Johnny was definitely a boost to our program. And then within the next round of this, which for some jurisdictions might already be happening, we were also able to have the Community Opportunity to Purchase Act. So in the early years, we didn't have the legislation where we were the first ones at the table. We actually had to compete with the private market and actually show our street cred, if you will, that we were actually a viable nonprofit buying the building with government funds, and a lot of times would get brushed off by sellers. With the Community Opportunity to Purchase Act in 2019, we were then able to have the access to the buildings ahead of time before they even went onto the private market, so that we could actually show that we were able to purchase the building without even having to wait for it to come onto the private market. So these are just some legislation. There are many more others that actually have really surrounded making the small sites program so successful in San Francisco, as well as there are many other organizations that are now ready to continue growing the small sites program beyond what it has been even in the last 7 years. And so going to, I believe that was my last slide. Turn it over to I don't know if we're doing questions or if we should just go straight to Rebecca.
Thank you so much, Karoleen. Yes, I think we're going to go straight on into Rebecca. You actually were able to hit a lot of the questions as you continued on. That was amazing. So thank you so much.
Without reading the chat, I apologize.
I know,
get to fully read chat.
You sensed them. You did. So all good. That was amazing. So we're going to have Rebecca Foster with the San Francisco Housing Accelerator Fund join us now.
Can we have a little game to see if Karoleen or I can talk faster? Okay, I think Karoleen touched on, let's see, here we go. A number of these that I will go through and focus on sort of the complementary pieces as much as I can. Karoleen touched on kind of the background of the small sites program and the growth of it, really from a pilot that was seeded with $3 million over the span of the last 7-8 years. This just gives a little bit of a sense also of kind of among the many goals of the program as it has grown is balancing both really addressing very strong displacement pressures in specific neighborhoods that are experiencing outsized displacement pressures, and also spreading the program around the city so that there are families who are at risk for displacement all over the city. And so balancing those two things I'll get back to in terms of the challenges and opportunities that come for the organizations that are actually managing those scattered site buildings in a larger geographic area. So just in terms of like the kind of like what we now are able to look back on from an impact perspective and look ahead on, I think we're all trying to build this movement around preservation and really emphasizing to our partners at the local government levels, at the state levels, with philanthropy, et cetera, like what an important piece of our affordable housing stool preservation is. And so we've been starting to work through in partnership with CHPC and looking at different data sources, really providing more of that full picture of the health savings, the boost in lifetime earnings for each child stably housed, those types of additional metrics. And also another key piece of this is like the small business spaces that are preserved oftentimes as part of the preservation efforts on the ground floor that stabilize neighborhoods as well. So one of the essential ingredients to make preservation work in pretty much any place in California, that because they're all high cost, is this subsidy layer. And to date, that subsidy layer in San Francisco has come entirely from the local government, and that's been one of the challenges in scaling preservation, is that there is, for new production, this sort of subsidy equity tranche is available, although competitive, from tax credit sources. And that's not a source for preservation projects, particularly small scattered site preservation projects in the same way that it is for new production. And so while the overall cost may be comparable or less than new production, the burden on the subsidy provider on a per unit basis can be higher without those additional sources. So this just shows both how, as the program gained momentum, the additional investments that the city and county made over time, and also for context, the average subsidy per unit that was coming from the city, kind of, ranging from $300,000 to $400,000 plus a unit for these projects over the last since the program started. It also shows, which we'll get to, how many community-based organizations were actively doing the development, acquisition, rehab, ownership work at the time. And so one of the key things that HAF worked on, in addition to the bridge lending role, in partnership with a bunch of the folks here, was looking at what sort of scale of a program is necessary to actually provide enough developer fee, asset management fee, residual receipts, if those are available, to sustain the community-based organizations that are doing the work. This is a landscape of a number of the organizations that are doing preservation work in San Francisco. And so part of that work that I referenced, which is where a lot of the analysis in this deck, which we'll send around to, came from, is we were really looking at how could we scale the preservation program. And one of the goals of scaling the preservation program was creating a program that would allow for like a sustainable ecosystem of place-based, community-based organizations. So the other things we are focused on and looking at kind of the scaling the program is really balancing out this geographic distribution of projects. As I mentioned, prioritizing protecting the most vulnerable populations, which oftentimes means the residents who are paying and can afford to pay the lowest rent, which impacts the overall financial feasibility of the project, but is a key goal for the project. And so balancing that alongside trying to really maximize the impact of those subsidy dollars that the city's putting in, and then supporting a sustainable CBO ecosystem. So this there's a lot of detail in here, but I think like the kind of the general takeaway, what we're showing here is what are the different drivers when you actually like do the math on an acquisition rehab project, what will drive how big that gap is. And so the big drivers that would lead you towards a lower gap that needs to be filled from subsidy would be that the average rent levels that the residents who are there can afford to pay and are paying are higher, so that they are at a higher average AMI. That's going to give you more revenue for the building, and that your acquisition and rehab costs are lower. And then at the other end of the spectrum, the higher with the things that are going to drive those subsidy requirements much higher are that your average your residents who are there are probably more vulnerable and are lower income, and so more vulnerable if they lose their housing to not being able to stay in the same neighborhood, let alone city, or being housed. That your rehab and acquisition costs are much higher, which oftentimes we experience in most of the markets that we're working in. Like, these are older buildings and often need health, life safety, seismic, et cetera, investments, and those are really expensive. And so those are kind of, this puts the various different projects that some of the projects that we've financed with bridge loans on this spectrum, with I'd say the takeaway point being, like, this is what we're balancing. Like, all of these things are important, and if all of your projects require extremely high subsidy, those subsidy dollars aren't going to go as far. So there's a balance here. So then the other thing that we looked at is, if you were scaling a program, what level of acquisition and fees would be necessary to actually support a sustainable CBO ecosystem. And so I'm going to move on to this slide. Basically, some of our takeaways, given the fee structures in San Francisco, is that at kind of getting to scale, that the developer sponsored community-based organizations would need to acquire at least 6 small sites projects a year to be self-sustaining. And that would mean that the developer fee and the residual receipts generated from those projects would be able to support their staffing. Now, you're not going to get to that in year one. So in this kind of startup phase, moving towards that, the organizations rely on other funding sources. So funding from other revenue sources within the organization, grant funding, funding from, in the case of San Francisco, government funding to help those organizations scale. And what we wanted to really, be real about and try to figure out is, like, how many organizations can be supported, so that nobody's set up for not being sustainable 3 years in, once you dive into this work. Another key thing that we looked at that I think is worth just touching on quickly, and then I think I'm about at time we can go to questions, is how you overlay that with what's actually available from a market perspective in the geography that you're focused on. So we did a look back with looking at CoStar data to actually look at, well, how much are different units in different building sizes selling for, how many transactions are there in which neighborhoods, and so that could help sort of focus on, inform how is this math going to work, how much subsidy will be needed to make acquisitions work in different neighborhoods. And in some cases, there's priority neighborhoods. For example, looking at this, our supervisor District 11 in the south of San Francisco, if we look at some priority neighborhoods, the building stock generally is more predominantly single family homes in this neighborhood. And there were 3 buildings sold in this district over a 6-month period of time. And so the other piece here is, like, how broad of a geography an organization is focused on is going to be a key factor in how many, are there even enough transactions on the market that might be a fit for a preservation program. So that's another overlay here. And I think to add to this, we've all gone through a lot of learnings over the course of the pandemic, in terms of underwriting these projects, how much you rely on the commercial rents. It's a very challenging interest rate and inflation environment, as we all know. So those are additional overlays that we're all trying to digest and hold as we look at scaling the work. I will stop there.
All right, we're going to move into Q&A. As to Ruby and Karoleen to get us going.
Hi, everyone. Thank you so much, Rebecca and Karoleen, for those inspiring and truth-telling, right, around what preservation means and in San Francisco, which is one of the hardest markets, of course, to do that here in California and across the country. And so it's really exciting to see you all being able to figure that out. And we're all still learning together, of course. So my name is Ruby Harris. I am with Enterprise in our Southern California market, and I'll be co-moderating the Q&A with my colleague Caroline McCormick, who is with Enterprise in our Northern California market. So we've got the market sort of covered here. And so we're excited to open it up to Q&A, which mostly we're going to be taking from the chat. Honestly, there's been a very active chat. We're really excited that everybody's so engaged. So the first question I wanted to ask was to everybody. This is something that came up. It was a theme that came up both in the chat and something that I was curious about as well. What are some of the key actions that the public sector, philanthropy, and other types of funders can do in order to really scale up this work? And open to who wants to answer that first, but I think each of you will probably have some good ideas.
I had one more slide that is very related to this that I will share.
Go for it.
So there are a few super exciting things on the horizon. Like, one of the biggest challenges that we've all experienced in trying to scale this work outside of San Francisco is this lack of permanent subsidy funding. And so I just lift up that there's some wins moving towards preservation on the horizon with the foreclosure intervention prevention program, which is $500 million in the state that will be allocated towards small site project acquisitions like these that are at risk of foreclosure. For those in the 9-county Bay Area, there's a BAFA bond issuance on the 2024 ballot, which 15% of that 10 to 20 billion will be allocated towards preservation. And so we'll benefit all of those jurisdictions if that passes. And then there's also a voter, and there's another initiative on the ballot statewide in 2024 that advocates are working to put on the ballot that would reduce the bond requirement from 2/3 to 50% for affordable housing, or the vote for affordable housing measures. So I'd say two things from the philanthropic, supportive side. One is get on board and push the policy, and especially in these second two, these campaigns need funding and are really important in terms of scaling the permanent funding. And I think the other piece that we're saying is, if you are ready when these sources come, then you'll be ready to scale and take advantage of those sources. So being able to stand up a pilot, try this in your community, and maybe that requires philanthropic funding to get it going over the next few years and a little seed funding from your local government. But if you can then work out some kinks and demonstrate that success, then in 2024, 2025, when hopefully there are more funding sources available, you'll be ready to scale, and there will be other funding sources, which I think is a really compelling pitch for fit philanthropy in terms of catalyzing future.
Absolutely. Thank you. Karoleen or Johnny, any other thoughts there?
I am going to transition, but I think I would leave you guys with the slide that I last showed, and I can go back to that slide again. It is on those 3 separate circles. Philanthropy will find which circle you want to be part of most, but I'll start first with the most selfish one, which is from the developer capacity. We've got a lot of folks in this call, I was gonna say in the room, but in this call who have different scales of readiness. And so being able to support them, I would particularly emphasize BIPOC and neighborhood-based ones, but that's just my personal preference, because that is the ones who actually will be able to move preservation also faster, because you understand your neighborhoods, you understand the tenants. There's a lot of questions that are also about like engagement, and that is key. If you can't engage the people who are in the buildings, we've seen that you can actually get into a world of hurt with tenants who are not excited about being not in the private market, but being part of a government regulated program when they've been so used to being in the private market as residents. So having folks who can properly engage the families that are living in these buildings are super important. So that's on the developer side, is having the ability to fund that, especially those first 4 years of ramping up. Rebecca showed the slide of sort of like, what does it take in terms of scale? And really, if you don't have that, it's very hard for organizations to pivot just on their own dollars and dimes. And the next is legislation, supporting either the legislation itself, as Rebecca is saying, and or the organizations that are doing that advocacy. I mentioned Council and Community of Council of Community Housing Organizations. That's the San Francisco-based one. There are also other regional ones throughout the state, as well as throughout the country, because I know some of you are not in California. Supporting those folks to push the legislation that pushes preservation, both again in terms of either legislation, meaning like a COPA, for instance, a Community Opportunity to Purchase Act, or the funding is super important, because at the end of the day, legislation sometimes does not get passed unless you've got folks helping to write the legislation, which is sometimes these grassroots organizations that are doing the membership representation and or the policy think tanks, right? And so supporting them is super important in addition to kind of just supporting the legislation itself. And then of course, putting the direct money into the funding, but to be honest, except for programs like FIP and the other ones that Rebecca was saying, the dollars are so huge that unless you are the seed funding, like San Francisco Foundation supported Meta in doing the program related investment, the buying of each one of these buildings, and I don't think just in San Francisco, but across the Bay Area and in California, is $1 million proposition. So supporting the ability to buy them is probably as important as the sort of direct dollars of like putting aside a $10 billion fund or a $100 million fund, which for some folks may or may not be possible. So that would be my suggestion, is those 3 wheels of trying to find where does your organization fit, where's your philanthropic efforts fit in.
Great. Well, I can take the next one, which is a combination of questions, I think getting at the same thing that came up in the chat. And I think having you all kind of talk about the HAF coming in 2017 and the role they played in really addressing this issue of like, how do you compete with private equity investors in the market? So that was a question that came up. And then also really helping to unstick some of the time issues with working directly with the local government to close on the loan. So if you could talk a little bit more about the relationship of the HAF in that, which we didn't totally touch on in the presentation.
I can do that. Can you guys see my share screen? I thought I'd show this briefly too. And Johnny, I think Karoleen, you got it run, but Johnny can chime in. So the biggest reason the HAF was created 6 years ago, was because of community-based organization feedback that there was this exciting new small sites program created, but it was really hard for CBOs to be competitive with cash and like fast buyers to buy, a 5-unit building in the Mission. And when they needed to go through the longer term process that's required to get the public sector dollars out the door. So that's a huge part of what our role has been, is to really be out in advance of those public sector dollars and enable the community-based organizations to if they need to, close in 45, 60 days in advance of, and then use private capital versus public sector capital that comes with more regulatory strings to go through a renovation process and stabilize the building, and then the public sector capital comes in once the building is stabilized. So I'll let you chime in, Johnny, on kind of any other pieces of that.
Just comparing the two models, I would say a 5-unit building takes just as much effort as a 50-unit building. And from that capacity perspective, we would not have had the success with smaller sites, where we also see the highest risk of displacement. We wouldn't have seen that success without the half. So that was definitely a game changer for the small sites with the introduction of the half into our small sites program.
I was wondering if you could both maybe touch on, since we're on the subject of renovation, how sort of the estimating renovation sort of upfront has been a challenge, especially in the acquisition rehab space, and how you account for that, or how those renovation budgets changed over time in the live projects as you worked your way through them.
I can take a stab at that one. It's definitely a learning process. We're still working on getting our estimates right. It just comes with understanding the different unit types, understanding the different typologies of sites. Here in San Francisco, we've got a soft story seismic retrofit requirements across most of the buildings here in San Francisco. And those can look different from building to building, depending on where your soft story is. Is it the basement? Is it the first level of residential? Is it a commercial site? Taking a commercial business out of business for up to a year can definitely put a big impact on your project budget. So those are things that, with experience of having those under our belt, we now have a pretty good assessment of what to expect going into these projects. So definitely lean on your other partners that have already done this work in the past to get an assessment of that. We know right now construction costs are through the roof, so just it's comparing what you've already worked on, I say, would be the best way to go about that.
The other thing I'd add is that when we've just done a look back on our portfolio of projects, where we've seen we've been the most off has been time more than cost. And particularly that is like more acute, where we've tried to include the financing and support the sponsors in adding accessory dwelling units. And so that's a relatively new territory, and the permitting and process associated with that has really taken a lot longer than any of us hoped or would hope going forward. So I think that's another key piece, because added time costs money. But I think like that, really being realistic about what that, availability of contractors, like all of those different pieces and permitting, that's where I think we've had the biggest misses in terms of being overly optimistic.
Okay, so I think this question is directed at Johnny / Karoleen. So of the different skill sets and considerations that Karoleen touched on for an organization who's just getting into this work, what do you think are the areas where organizations often are underestimating in terms of the amount of either staffing, seed and operational funding, or sort of capacity, access to capital? Where are you seeing folks kind of underestimating the amount of work it takes to really scale preservation within an organization?
I think Karoleen has left, so I can try to take a stab at that one. If you remember back to one of the first slides that showed the org chart of the different skill sets needed for preservation, in the beginning, you are going to be wearing all of those hats. You're going to be wearing the asset management hat, the project management hat, the construction manager hat. I would say, if we had to go back, definitely setting up the asset management, the finance guru expert that can see ahead of what these projects are, or the impact of the projects on the organization. I would say that's where we would have maybe put a little bit more effort or emphasis on in the beginning. We were definitely heavy on the project management side, going after the next site and the next site. We were, looking to stop displacement across the mission. So that was our goal. At one point, there was a backlog of sites that were in queue to have construction. We just didn't have enough boots on the ground to manage those construction projects while at the same time taking on the next acquisition. So I would say having somebody dedicated just to the construction and making sure that projects are going through that cycle, in and out of that the construction development cycle, along with the long-term asset management of the site.
These crimes.
I missed that.
Thank you. I'll kind of piggyback on that a little bit. There was a question in the chat around systems. And I think it was more related to, I think you started to talk about that, but it said systems and apps. So I think it was more related to sort of the mechanics of actually tracking this type of work, what you put into place in order to do that.
Systems
and Boscad will come to you next. And anybody else who wants to raise your hand, we're happy to have you join the conversation as well.
As far as systems and apps, I would say Salesforce is definitely one that works across multiple partners and organizations. Taking and using all of the tools available from that, I think, would have been key in the beginning, with 3-unit buildings, 4-unit buildings in some level of construction, and managing multiple sites at different levels of development. Having a tool in the beginning would have definitely been more helpful. And at that time, everything lived in an Excel, everything lived in a pro forma or an Excel timeline of where the project was at. So that was definitely tough to manage in the beginning. Not that Salesforce wasn't around at the time, we just didn't have it at its full capacity when we first jumped into the small sites work.
All right, Oscar, you want to unmute and join us?
Yeah, no, thank you. So quick question. So I was curious about how does Meta hold the properties, or do they work with like a community land trust to hold the property? Is my first question. And does Meta have any community limited equity housing co-ops in their portfolios? And how does that work?
Sure. First part of that answer is Meta owns the buildings outright. There is not a JV partnership on any of the small sites. JV partnerships, we are JV partners on providing technical assistance to other small sites developers, but the buildings in the portfolio are fully owned by Meta. And then as far as limited equity, that is not something that Meta has explored yet.
And you said yet, so is that something like y'all are cooking in the kitchen right now?
I mean, it's definitely something that we've all been asked and tasked to look at. The land trust here in San Francisco does have a couple sites that are exploring that model, but we have not brought those two worlds together, which is limited equity and small sites. But definitely something that is on the horizon, at least to explore, to see what that could look like.
Okay, no, that helps. Just because that's in San Jose, that's what we're working on, is like the, I guess, community land trust model with limited equity co-op model. So it'll be great to see what y'all come up with in a couple months or years.
Absolutely.
Thank you.
Okay. Feel free to jump in if you want to ask the question live. Otherwise, we'll kind of keep working through the chat and making sure we captured everything. There's a question to the half from Molly, and Molly, we may need you to clarify. The question is, what level of funding is the half issuing? So do you mean on a per project basis?
Yeah, per project, just to give myself a sense of, how you structured the program to support acquisition of small projects, and what types, what level of funding you're using to leverage and help position projects to move forward quickly.
Yeah, so we size our loans based on the cost of acquisition, rehab, and capitalized interest generally, because there's usually the rehab means like there's not a lot of interest payment during the term of our loan, and so those are often like pretty high LTV loans. We usually require something in the range of 2% sponsor equity and kind of try to be as flexible about that as we can, based on the sponsor's capacity, but have some requirement. And so those ranges depending on the building from a $5 million loan to a $40 million loan for the bigger sites. And we are able to do those really high LTVs because of our relationship with the city, with MoCD. And they issue a soft commitment letter that isn't binding, but that essentially gives us enough comfort and our investors enough comfort because of sort of like the track record behind that once the project is stabilized, that it will be in the queue, assuming it continues to meet all of it, the criteria laid out for their subsidy at takeout. And so because of that, we are able to get comfortable with what sometimes are, 300, 400% LTV loans, if that answers your question. And we try to be competitive from an interest rate perspective. And as Johnny knows, that's been super hard lately for everybody. So we're really, the more larger scale projects we do, the more we need to bring in outside capital that is usually indexed to treasuries. And so we have a super large outstanding portfolio because of some home key loans right now. And so we have, we can't totally insulate ourselves from the rise in interest rates. So we priced ranging from, 2.5% in some market environments to 6+% in other market environments, but try to be below what people can get otherwise.
Rebecca, you mentioned some pretty high LTVs there, but do you have an LTV limit? Does the half have a limit? That's a question in the chat. Okay, thank you. And
what is
Krista,
sorry, do you mind if I ask a follow-up question? What is the length of your loans? And then is the capital that you're using primarily from the housing bond that you're issuing?
So the length of our loans, we have one 18-year loan, but these loans generally for the preservation are shorter. They're 2 years-ish, plus or minus. It's really like try to get in, stabilize, rehab, and then bring in the city's longer term, lower cost capital. And we're an independent nonprofit. So we do have a $20 million investment from the city of San Francisco into the half that's subordinate 0% capital, which helps us average down our rates. But we have about $300 million in total capital. And the rest of our capital comes from a mix of bank loans, foundation loans, and grants that we try to revolve from philanthropic partners.
Thank you. We've got, sorry.
Oh yeah, I was going to say, Crystal, you've had your hand up for a while, so I wanted to make sure we got to your question.
Hello, thank you. I was wondering, because we are in Southern California, Inglewood to be exact, Los Angeles. So Ruby, this might be a question for you. Are there any organizations, because I like to learn from those who have done it so I can get some best practices and mistakes not to make, that you are working with that I could glean from, because we are just starting off?
Yeah, definitely. I will leave my email address in the chat and I can try to connect you to the right folks down in the LA area. Definitely. We've got just 1 minute left. So we have time maybe for one more question if somebody wants, does anybody from the audience want to ask it? If not, I've got one. All right, there's one for you, Johnny. The question was, what skill set should a project manager have, and does Meta broker their own
Hustle.
deals?
You gotta have hustle. These projects move at a very fast pace. They are tenant driven. This is not a regular transaction. If folks are not on board, you need to move to the next one. These projects can be very impactful for folks that are at risk of displacement. They also can make a big difference in areas and communities where new construction is not possible. So you got to have all hats on, the developer to community organizer. So I would say a jack of all trades.
Thank you. I appreciate all of that. And like I mentioned in the chat earlier, we're gonna, for the questions that we weren't able to get to, some of them are very related to future sessions. And so we will definitely be bringing some of these themes back up, and we're gonna be having these calls through June. And so there's a lot of more opportunity to talk. And we will be sending out a recording of this session with all the materials. Thank you, Rebecca. Thank you, Johnny. Thank you, Caroline. And thank you, everybody, for
Thank you,
being,
Enterprise. This is
Yes.
amazing.
Thank you for being so interactive in the chat. We really appreciate it. And I'm going to pass it back to Sarah, who's going to close us out.
Great, thanks, Ruby. All right, hello, everyone. Again, amazing conversation. Thank you, everyone, for your engagement and questions, and look forward to continuing the journey with you. I'm going to give a very quick highlight of the Preservation Next toolkit. Want to highlight some of the aligned content in the toolkit that you can go and check out. And I think that Jesse will pop the link for the toolkit into the chat as well. So I'm going to go ahead and share screen. So this toolkit is live. It is also continuing to evolve and grow. So we'll be working on it again as we go into 2023. So if you have ideas and thoughts, we welcome them. So as we go into the toolkit, I just want to quickly highlight some of the areas of content that align with today's conversation. So first, we do have a developer capacity brief. So we call all these topical sections issue briefs, where we're really seeking to highlight critical content around preservation of small to medium multifamily. So as we think about capacity, it is in terms of this smaller stock, of course, in alignment with our presentation today, and highlight some critical factors that you'd want to consider as you are either embarking on this journey or as you're maybe seeking to expand the work that you're doing. In addition, we also talked a lot today about the importance of the ecosystem and environment that you're operating within. And so we do also have an enabling environment brief, which highlights, the key regulatory and policy environment, the resource environment, what support for capacity building looks like, so that folks who are on the call that might be advocates or policymakers, work for local government, things that you might consider, as well as folks that are developers or emerging developers and markets, understanding the pieces that are really necessary. So this goes back to the great visual that Karoleen shared that we'll share out with everyone as well, about all the pieces. In addition, I'll highlight for folks, we do have state of the market briefs, you'll see here and over here, that provide kind of a snapshot of markets, and this is aligned with Enterprise's markets, but for folks in California, you'll find one for Northern California and Southern California. In addition, we will dig into this in session 4 in early January, but we do have a financial modeling tool, which is available for download. And it's not only to look at feasibility of deals at acquisition and rehab, but also long-term operations. So, obviously a big conversation today has been around what resources you need to have as you start, but also understanding how these properties will impact your long-term operational sustainability and growth. And then lastly, I just want to highlight our case studies. So we also have case studies of real live small multifamily preservation deals, 4 of which are from our California markets as of now, which highlight how those projects came to be, who the different partners were that were engaged, how they were financed, and challenges that were overcome. So I encourage you to check out those case studies. Again, we'll be continuing to grow this toolkit as we go into next year. And if there are any case studies you'd like to elevate from your locality, we'd love to hear from you. Questions, comments that you have, please reach out. We'll continue to highlight sections of the toolkit as we move on in our agenda with our sessions as we go forward. So on that note, I think, Jesse, if you'll pop up quickly our next session. So our next session will be on December 1st. We'll be focusing on acquisition. So thinking about identification and evaluation of small multifamily properties, and really thinking about that in terms of alignment with your mission, your capacity, local priorities, and feasibility. And so really excited to have a couple of guest speakers that will be joining us. Andrew Jacopovich, who is with Enterprise and leads our policy research team and has done significant research on small multifamily inventory across the country. He will be sharing some data both from a national level as well as some California specific analysis. And then we'll also have Chris Cummings joining us from TNDC, who will be talking with us about tools that they've employed to assess alignment of potential opportunities with their organizations. So really look forward to this next session. As a reminder, we will share out the recording, slides, and mentioned resources with folks who registered. I think probably give us until next week-ish just to get those to you. As we need to get them downloaded and all that good stuff. We have the holidays approaching. Jesse has also popped the registration link here, so you can go ahead and register for our sessions. And with that, I think we are at time. Those folks who are part of the cohort, please remember to join us. You have a half-hour break and you'll see a Zoom link in your invite. So we'll see you in a half an hour and dig in further. But thank you so much. Thank you to all our speakers. We really appreciate it. Great session, guys.